This is a Momentum Media production.
Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Okay, how you going? Phil Tarrant, co-host of Property Investing Insights with the Right Property Group. We've been doing this for many years now. One of the original property podcasts. Now every man and his dog's got a property podcast, but this is one of the absolute originals with one of the absolute original buyers agents, trades, an industry that's changing rapidly. And I've got some concerns and issues around maybe how it's developing a little bit, and I've been sharing them over the last period of time. I'm still really yet to form my opinion on it, but I think it's a very important juncture for buyers agency in Australia. We are very fortunate that we've had over a couple of decades a cadre of very capable buyers agents who have been delivering to Australian borrowers and Australian investors. And this was before it became popular to be a buyer's agent, before when people actually knew they existed and what they actually did. One of these original organisations, Right Property Group, has been at it for probably nearly 20 years. We spoke about it on the podcast not long ago. Joining him in the studio, Victor Kumar with Reshmi Kumar. Reshmi, you're now like you've got some C-suite executive title these days, don't
goodness.
you? What's your role at RPG? I never call it RPG.
RPG.
Boss of Victor Kumar.
Boss of
That's it.
keeping
That's
Victor
right.
in check.
That's right. Just keeping it.
Yeah, keeping the organisational engine behind
Keep it
Right
all
Property
going.
Group, giving a sense to growth and development. So welcome to the podcast, Reshmi. Victor, how are you going?
Thank you.
I'm good, sir.
Good. Now, we've got to talk about it because everyone's talking about it. And probably one of the very few times I've seen you, and probably one of the very last times I've seen you, maybe come out of the shadows and engage and entertain a journalist who you might not know very well and down the pathway of education and trying to sort of give some narrative and a sense for property investment in Australia. I saw you on the ABC
Oh, my God.
recently. I saw you on the ABC. I was actually sitting here just outside of our podcast studio and I was chatting to someone else and I went, that's Victor Kumar. And I rushed around.
I know him.
I know him. Oh, wow, I didn't know he was famous. I did that podcast with him. How long have we been doing this podcast?
6 years.
Six
years. Going to 7 years now.
7 years, yeah. And I went, why is he on the TV? And that's unlike Victor to see him on the TV. So I rushed around to try and find the remote control. I just got the back end of it. But then someone shared with me an article which headlined you, and this was with the ABC, the Australian Broadcasting Commission. And I think the story was, because I'm still not too sure what the story was about, or what I read online at least, it was trying to maybe someone that might not necessarily know a lot about property trying to do a story on property, and they were sort of getting mixed up with whether it was a story around negative gearing or whether it was a story around how there's all this huge cohort of property investors who dominate the Australian property market. And there's a lot of information in there I wasn't too sure about. I didn't really get. But I thought, what's Victor doing on the ABC? Normally you wouldn't do something like to come out of the shadows, because normally you're quite a sort of, you're very open professionally and engaging with your clients, but you don't normally give too much away about yourself. So
No. And I came home and said to Reshmi, I think, we've really been, I should say, misquoted. I'll be very diplomatic over here. Misquoted in terms of what initially was someone reaching out to me and saying, hey, let's talk about, the number of people that own multiple properties. Let's talk about what's happening in terms of the rhetoric with negative gearing. And so, of course, I did a big spill about negative gearing because, as you know, I am really passionate about how people hang their hat on negative gearing as part of an investing strategy. So, I talked you to death. Didn't get one mention of negative gearing.
Didn't even touch negative gearing.
Didn't even go there.
Yeah. So that was interesting, an interesting exercise.
Was it a classic bait and switch, or do you think they went, I'm going to go and do a negative gearing story, but you gave it more interesting stuff?
Look, I think they realized that they had a big leader headline with if they could embellish the numbers a little bit with what was said ad lib during conversations. And I think the producer got involved and said, this is bite-worthy. Let's run with this. Let's forget about negative gearing. This is how the article will look, and this is how the TV piece will look. And the rest is history. And the Facebook comments in there, really, they weren't bad. They were not trolling or anything like that, but it really showed. And we were talking about how there's no education, financial education and life education in terms of how negative gearing really runs, right? So the comments which were, how dare this guy get his mortgages paid by taxpayers' money?
Yeah.
So the assumption was that they're taking all of the other taxpayers' money, helping me pay for my mortgages. I'd love that.
Imagine
that.
Gosh.
and I do note we're recording. People who tune in this podcast are property investors, right? So
they already know how negative gearing works.
It's an echo chamber where we are right now. Well, maybe a lot of them don't really understand, appreciate how negative gearing works, and hopefully they're using this as a way to educate themselves. But I think maybe to those Facebook commentators, they're not going to know, and they don't really care.
No.
It's not the forum.
It's not the forum. So we'll let that go to the keeper. My base sort of position with journalism, and I guess that's what I do for a living. I'm a journalist, and I lead a very big team of journalists and content professionals here, is that we always approach anything with you play the ball and not the man. It's okay to debate an issue, and it's okay to give differing opinions on a particular issue.
And difficult questions.
And difficult questions. You don't play the person, right? The CEO of a bank, for example, right? Like, he's an executive whose job is to the interests of a bank. So, you debate the issues. You don't go after them personally. That's just not cool. And I thought that story, when I saw you, would have been a lot more aggressive than what it was. I was like, it just wasn't really a story. I think they try to give a sense of, like, there's this big group of people who own all the properties in Australia, and it didn't really come out like that.
No, it didn't. It didn't. It sort of alluded that, the top tier investors control about 70% of the investment properties. I don't necessarily think that's correct. Certainly how they're portraying it was more so down the path of, you have to be doing something really extra special to be in that top group. Whereas with us, we were discussing how we've got plenty of clients that have more properties than what's been reported there.
Yeah. And this goes back to my earlier point around where this industry is getting positioned at the moment. And I always revert to the position of, I've used a buyer's agent for the majority of my property purchase, nearly all of them. And the reason why I do it is because they provide a level of service and capabilities that I don't have. Number one. Number two, I'm time poor. Number three, they have relationships that I don't have. And number four, it's a really good sounding board for me as a professional to use it. And I think that there is where this sector can really drive and thrive, and it's where Right Property Group has always sort of operated and positioned themselves. That the narrative's getting shifted a little bit. Maybe we can chat a little bit about that, because it's connected with a wider theme for today, that everything's been now gets swung back to this idea of how many people own how many investment properties, and like that's the most important thing, which is not. And it's always this frame of reference going, most Australians only have one or two property. Then you got this cohort. I think this ABC story said there's only 172 people in Australia with more than 20 properties. Well, I know personally that many, who would have more than 20 properties. So I think this is where the data doesn't really meet the reality at all. And I think that basis there is, you've done some research on it, there's actual tax file numbers is connected with 172, which probably smells about right. I don't know how many individual people own that many properties in their own name. That'd be tough, or a trust. But, the key thing is that we've got to ensure that the language and narrative and what buyers agents do isn't all around, I've bought this many properties for someone under market value, because they do so much more.
That's correct. That's correct. And also, equally importantly, I think, and in reference to the article as well, it's really important to understand that it's not the number of properties someone owns that gives guarantee to this service. It could be 100 dud properties. Yeah, or it could be 100 off the plan properties. Or maybe
in one transaction.
Yeah. And
it's just
I'm
doing
sure it
one
happens, right?
transaction.
The numbers don't always tell the story. But what I took mainly from that story, and what I'd like to talk about today, it's the focus and the thrust of it is going the wrong way. I think it needs to be spun on its head. And why is the reason why people don't actually build large portfolios? And this isn't often spoken about. And I think if you pull it apart and break it down, it's going to give people a lot more clues about how you go about doing it. And I think this is intrinsically connected with some of the things we've spoken about. What we'll speak about is like negative gearing and lending and all these building blocks, which is normally just get the salacious headlines, but there's actually, quite a lot of science to it all, particularly around negative gearing. Education is absolutely critical. It's one of the reasons why we've been doing this podcast for many years. And I don't know how many clients you've worked with over Nearly 20 years you guys have
not
been in.
many after they hear your podcast.
You reckon? They're sick and tired of it, you know.
Oh, gosh.
But have you ever sort of worked out how many clients you've helped?
We actually are in the exercise of doing that now, because it comes back to how you really count.
To build portfolio for
Yeah.
more than a couple of thousand.
Okay.
really.
Yeah.
So,
She's now the business data.
That's what I mean.
Yeah,
Like,
I'm the
you were trying to say, oh,
Yeah.
well,
Trying to
she
punch
knows.
through that. Yeah, she knows.
because I'm on the numbers all the time.
Yeah, you're in the
so-
numbers, yeah. So that's a couple of thousand people who,
Yeah.
Yeah.
So we've helped.
Yeah. And this is not just one property. These are multiple properties, right? So the number of people that only have one property is either limited by borrowing capacity, circumstances, or simply loss of appetite, but they're very few in comparison to the thousands we've helped that are multiple property ownership.
yeah. And you would find that most, I'm just assuming that go down a pathway using buyer's agent. If it's not for the purpose of owner-occupied property, let's put that aside. We're talking about for the purpose of investment. They typically have a degree of sophistication and awareness through podcasts like this where they would engage a professional to help them on that pathway. That's what I'm seeing more of, that cohort.
Yeah. Yeah, there is a lot of education out there. Now, like I said in previous podcasts, the downside of today's day and age of information is that there's too much information.
Yep.
And so, which strategy do you take? And same as when we started, when we went to the different seminars, we were sort of worried about, or confused about which way we go.
Yeah.
And then we
Just decided to use whichever strategy we were comfortable using and what was simple to follow.
Yeah, and you moved around. We've spoken about it beforehand. You went down one pathway and then another one, another one. Now you've got
We
it
tried a few things.
largely. But that's what I think the ABC story missed is like the mechanics of actually building a portfolio rather than just the sensationalist headlines around it. And negative gearing, it's not a strategy for creating a portfolio. It's a tax outcome, right? But to your point, and this article was supposed to give reference to or infer exactly what's going on with negative gearing. It pops up every now and then with there's going to be changes in negative gearing. There was a bit of, discussions around it probably 3-4 weeks ago, and everyone's like, no, it was on the headlines everywhere, and now it seems to be dissipated
It
quite
has
a lot.
dissipated quite
I think it's gone to the keeper. The upcoming federal election will be won and lost on housing policy, and we've telegraphed that before. That everyone's saying it now. We've been saying it for a long time, and it's going to become in many iterations. You see even the coalition's now coming out with a really big housing policy, which will be interested to see when it's all handed down. But let's just talk about negative gearing for a moment, because you said that this is something that you're right across, right? What was the story supposed to be about on negative gearing with the ABC?
So the story was...
What questions did they ask you?
As an investor that has multiple properties and a large portfolio, how will it impact you when negative gearing is taken away? And
how will it impact you when or if negative gearing is taken away? Was it if or a when?
I think it was a when. Yeah.
Okay.
Will it cause you sleepless nights? And what do you think the impact will be on the general populace? Right. So, of course, I gave my answer in true Victor fashion,
which was
that it's a sovereign risk. If you're investing and the rules change on you, it is a sovereign risk. You can't control it. And if you've built your portfolio totally around the strategy of getting tax benefits and that's the only way that you can hold on to your portfolio, then you're in trouble. And then I referred it back to during Paul Keating days, where we reversed negative gearing very quickly after we'd taken it away. I think it lasted only 9 months from memory.
Yeah, what's a long time?
Where the very people that they were trying to help suffered the most. So what had happened over there is that when they took away negative gearing, naturally there was a little bit of a lag, and some people panic sold, as most the uninformed normally do. They panic sell when there's a flash in the pan news like the Queensland land tax scenario, all those things, right? So those that were fearful, they sold. Those that were connected to the process, they just simply, after a little lag, they started raising their rents. And the rents actually went up by 20%. And they very quickly realized that, hang on, this is going way the opposite direction to what we wanted. So they reversed it because it had killed the market, pretty much killed the market. And the rents then contracted by a couple of percentages. So this change, this negative gearing change, actually benefited the property investors by increasing their rent. And the incentive for negative gearing came back again, which was good.
So it really accelerated a new baseline for rents,
Yes.
which probably wouldn't have happened.
Wouldn't have happened. It would have taken probably 5, maybe 7 years to go up to that
And
level.
it's like building supplies, right? They all get expensive. They don't go back to where they were.
No, they
It
don't.
just normalizes and that's where it is. And did that logic have currency with the journalist you spoke about?
There was no mention of it.
Okay.
Yeah. So I think
So it was just a boring story.
it
You
was a
didn't give
boring
me-
story. It was too logical. It was too logical. It was too meta-factual, I think. And there was no sensationalism in it.
And this is what negative gearing is. It's a, inverted commas, boring tax outcome,
Yes.
right? And again, it comes to, we're chatting with property investors, so they're probably more informed than most, but people think they immediately get these discounts, or get these tax incentives from the government. Now, yes, you can do that. You can actually set up your personal income tax so you get a contribution or it's offset on a monthly basis. I can't remember what you call
on
it.
a pay cycle. So it's called a PAYG income variation.
That's
what
right.
used to be, if you've been around long enough, the 221D.
221D. So that's where you need to actually highlight to the tax office that you are going to be negative at the end of it,
Correct.
and then they'll get a contribution.
Yes.
Or it's done when you do your tax at the end of the year.
Yeah. So a really good, easy example of it would be, let's say you have a new building, and let's say the depreciation on it was going to be, because you've done a depreciation schedule, and the depreciation was going to be $10,000 in the first year. You can log that in to say, I will be claiming $10,000. So ATO then writes to your employer and says, withhold this much less tax
Okay.
from your pay packet. So you get an artificial pay rise, which helps with the holding costs of it. And the reason why I'm not a big fan of doing it that way is, as human beings, when you have a pay rise, we tend to find a expense rise
Another
as well.
expense.
Yeah, these two always go hand in glove.
do
You think you've
go
got
hand
more
in hand.
money, and then you've still got the tax
Yep.
Yeah.
complications at the end. Is it a common thing for people to do? Like, I don't know how many people do a variation of the monthly thing on their PAYG income.
Some do.
Most
It
people
comes
don't know.
Yeah.
Yes.
Yeah.
It comes back to the accountant, the advice from the accountant, and the actual the investor having the knowledge to then flag it with the accountant to say, hey, I want to do this. Because if you get the numbers wrong in terms of overclaiming, then there's a penalty in the end.
Okay.
Yeah. And then the following year, you can't do it again. This is how I understand. Obviously, your accountant
gotta
would
get the
be able
advice.
to give you better advice on it. But that's how it generally works.
Okay. So negative gearing, I can't see it changing.
No, I don't know.
I can't see it changing it. It would be very difficult. And you always get, armchair economists or even economists and consultants they do this research all the time. And the base assumption is it might have a very small and minute immediate change to property prices, but longer term, you're better having it than not having it.
Correct.
That's typically the advice that comes through eventually. So I can't see the government changing it, particularly when, I don't know, it's neither here nor there, but I guess it's relevant. Albo buying his fancy house up in Copacabana. Good on him, by the way. I think it's
that was
absolutely
lovely.
brilliant. He's a 61, 62-year-old professional who's been working for 40 years. You'd expect he can go and buy a pretty reasonable house. It's not extravagant by yes, $4 million a lot, but it's not extravagant by many means. However, it's probably made his life a little bit harder in Parliament. When housing is going to be so closely connected with the election, your appearance on the ABC, whether it's on the TV or in paper, just goes to show that most people aren't really informed enough to actually have a considered opinion on it. It's just sensationalist around it.
Yeah.
It is very much so. And this is where, if you're in a position of limelight, you have to be very mindful and have a thick skin as well in terms of whatever you do gets under scrutiny, and under scrutiny for the wrong reasons.
Can we expect to see Victor again in the paper at any point soon, do you think?
don't think so.
No? Is this an exclusive? You're only exclusively talk to Phil Tarrant? Is that the...
That's
is
it.
that it?
Yeah.
Okay, well, I'm going to try and stitch you up. Have I ever stitched you up? Have I ever...
No, once you threw me a curly question, I'm going to go back to the episode and we'll highlight it. You threw me a curly question. I think I came out relatively unscathed on that one. But
Do you reckon I should be asking harder questions?
But I don't know whether you've got it in you.
I don't know. I don't know. Maybe that could be the new thing that we could do a new installment of this. The questions that Victor doesn't want to answer.
How about we start ending this podcast with here's the curly question for today.
The curly question for today. All right. Well,
curly question corner.
Curly question corner. All right. There we go. Well, I'm going to be thinking about that.
Yeah.
How about you, Reshmi? You think of the first question today.
God.
The curly question corner for you guys. The question that no one wants to answer, but everyone wants the answer of. But so it comes back to the point, negative gearing being, the catalyst for that, but it's a story that went somewhere very different. But the key thing to take around from this, particularly with people on this listening to this podcast, is the reasons why people don't build large portfolios. A lot of the times it's a structural reason why they don't build a large portfolio. Some of the times it's a mindset issue, and then I'd say also one of the reasons why also is because they can't, because they don't have earn enough money, right? There's probably three key pillars around it. Let's start with structurally. That's how I would summarise it. Did I miss anything on that?
No, yeah, pretty much.
It gives us so structurally why people don't build a large portfolio. Where do we start with that, Reshmi? Do you think?
Oh gosh. I was not ready for the structural part. The foundations, I guess. It's the foundations aren't right. They haven't got the right knowledge around how to do it. And so I think without that knowledge of how they're going to do that, I think they don't know what the first step would be. So structurally, what would
it's a lack of structure.
Lack of structure, and also it's the lack of why they get stuck more in the how, right? So if the why is big enough, you'll always find a way, ethically and legally. So then it comes down to, okay, is your circle of friends and your circle of influence, are they multiple property owners, right? And one of the reasons why we did can't let go of a plug, mate. One of the reasons why we did Right on Track is to get people in so that they can rub shoulders with people that have got more properties than they have.
Like a positive peer group.
Yeah.
One thing I would say is as soon as it comes about property investing, people talk about buying a property.
Yeah.
That's the main thing, and that's not what it is. So buying a property isn't property investing. There's a lot of other work that goes around. Why? So that's the structural part.
There's so many sort of sub-segments of structure, right?
Yeah.
There's to your sphere of influence, right? And if luckily, there's pros and cons with it. There's so much information out there right now around property investment. If you're not actually connected, engaging with other like-minded property investors, and you're right on track versus, there's a lot of Facebook groups around it. I don't know if you ever look at those. I try and avoid them, but
I'm the silent lurker on those.
Yeah. So and a lot of the time I just go, you've got to be careful of, it's good to be surrounding yourself with people who are interested in property, but make sure you're surrounding yourself with people who have the right attitude towards property. Some of those Facebook groups are armchair sort of warriors who, it's a lot of danger in there as much as a lot of good stuff. I don't know. You look at it. Do you ever get hassled on the?
No, I don't post. No. I don't post. No. Like I said, I'm a silent lurker. Yeah. Right? So this ABC was the exception, and I'm regretting it already. But when you look at these Facebook groups, these discussion groups, there's always someone there with an agenda to sell something. But let's take that away. There's always then someone there that's going to be a troll and say, no, it can't be done that way, or why did you do this, or why did you ask this question? So this is where you need really a nurturing space to be able to do that.
There should be no Facebook group. It should be face up group. Like face up, straight face to face, ask those questions face up.
It sometimes can be, and property is an interesting. It's really interesting sector of investment because it's an enabler for a lot of people that normally wouldn't have an opportunity to create wealth in a quite a considered and predictable way. But it sometimes attracts some pretty nasty people into it.
It does.
It's and whether it's it's a low barrier to entry property. I think it's very accessible to most. And unlike stocks and shares, which are a little bit mysterious, and you've got these sort of gurus that tell you where to buy and when to buy and how to buy and all that sort of stuff, you get a bit in property. Property is a lot more democratized and considered with most Australians, and it's good and bad because there's a lot of misinformation out there.
There is. And if you come back to structure, I think in terms of when people get started, like I said, it's you need to focus on the why. So that's an end point.
Getting in for the wrong reasons, right?
And making sure that you're buying the right type of property for your age bracket.
Yeah.
And for that cycle, and for that income bracket as well.
Yeah.
Right? Because you can't. Let's say someone's earning, say, 200,000, as opposed to someone earning 80,000. The two types of properties that they can buy are different because for the simple borrowing capacity. But it could also be that the 80,000 is able to build a bigger portfolio than the person earning 200,000 because they have less discretionary spending.
Yeah, and I was chatting with someone the other day and they're saying like there's people in corporate life who, there might be middle management and they're a lot wealthier than the CEO of the company because, they're just deploying their money more effectively. And again, that sort of comes to the point around why people don't build large portfolios is I think it's actually a principle in some sort, but the more you earn, the more you spend. So when you're sort of rationing your dollars, you typically make better financial decisions, right?
You do because you're hanging on to your dollars a lot more wisely.
There's people in the comfort zone level, right? So it's no need to do anything more than that.
Yeah, and also if you're earning big bucks, then you're rubbing shoulders with other people that are earning big bucks. Then the flashy toys and all that play comes into mind, and you need to then have a house to match your income status. You then have to have a car to match your income status. The kids now need to go to the best private school because you can afford it, and there's nothing wrong with that.
Yeah.
And then before you know it, there's hardly anything left over for investing. And then, of course, you then start focusing on, okay, I'm giving so much tax away. Let's buy a property and grab some tax back, and that'll help me hold on to the property. And if you look at from the yesteryears, that's how property investing was pitched, was use your tax dollars for the cost of a cup of coffee per week. You're going to hold on to the property. I can still see the headlines when we were starting to learn.
I think those days are largely gone. You don't get too many people out there sort of. But, it might come back. We're only chatting off air very quickly. There's some potential changes to stamp duty in Victoria. When that happens is if you're buying off the plan apartments, there's no stamp duty. Yep. You're going to start seeing a lot more of that.
That's right. That's right.
Back to that cycle.
Yeah. Well, look, I learned a very long time ago with tax and with government incentives, there's no such thing as free lunch. Yeah, so you will get a sting in the tail, whether it is, okay, you didn't pay stamp duty, so there'll be some level of clawback at that point in time, or naturally the property prices will inflate to compensate for the money that you're saving. And also, if that's the only reason that you're investing in, and that was the one that pushed you over the line to actually buy that type of property, you could potentially end up with a lemon.
Yeah, a lot of people with lemons in property. That's the reason why, back to the stats, most Australian investors only own between 1 or 2 properties, right?
Yeah.
The appetite isn't there. I think it takes a certain type of person to be able to build that type of portfolio as well. So.
It's a huge mindset thing, right?
Yeah.
You've got to be. It doesn't happen by accident.
No. And people equate owning properties to owning your home mortgage, so therefore you're contributing the whole lot to it, and that's the mindset they come in with, which sort of constrains them. Then there's the hangover of our previous generation of, you need to pay off your home first and drop the debt down low just in case something does go wrong. So they're waiting that much longer to then start investing. And so they've left their run a bit too late as well. The idea is that you want to be starting as quickly or as early as possible. And having spoken with many investors that have got multiple properties, I asked, my parting questions always been, what would you do differently today? Every single successful investor says exactly the same thing. Wish I'd gone harder in the beginning. Right? They need to really scale in the beginning, so it gives you more time to then let the property mature. And that gets you into your next year.
Yeah. I really sometimes struggle with that because I sit there just going, we've spoken about this before, I could have bought so many more properties over the time I've been investing in property, and I haven't. Yeah. And there's all reasons why and stuff. And even today I sit here just going, I'm still not doing enough, but I'm not doing anything about it.
No.
That's interesting. And then you sort of compare and you contrast yourself to other people, then I go, I really should have done a lot more I know I'm going to be sitting back in 10 years' time going, I should have been doing heaps more than what I'm doing right this moment in time, right?
Yeah.
And this is a mindset thing. You've got to actually own it and take action, because otherwise nothing happens.
That's right. We, if we look at our journey, we've slowed down in terms of buying properties, right? And we even on our construction side, we're taking our time with it now. Whereas in the early days, if we saw an opportunity, we would do anything and everything to grab it.
Yeah.
And so in the early days, the portfolio was going in terms of numbers was quite strong and pretty much changing on a monthly, if not quarterly basis.
There was a time we bought a property a month. One that the 2018.
28,
something. There was a lot of properties.
Probably a month. That's a lot of property.
Yeah. And during the GFC as well.
Yeah.
So we did that. So
Great times.
Yeah. And that's the journey, right? So if I equate that, take away the numbers. If we look at it from a process point of view, the banks were willing to lend the money.
Yeah.
And when they were willing to lend the money, we went hell-bent for leather.
Yeah.
There comes a time when the bank's no longer willing to lend you money. Policies change, the appetite changes, the economy changes. That's when you hold on.
And that's one of those big points, right? Is access to money is a key reason why people can and can't build a large portfolio. But back in the GFC times, sort of we didn't start.
It started just on the tail end.
Just the tail end of it, and it was so easy to get it. It was just easy, right? Like it was. Didn't have it. Like it was because you didn't have it was easy because you didn't have. I don't know. You probably had a lot more property then, but it was still relatively easy compared to today. It was easier for brokers to do the business of broking. It was easy to get the debt. The numbers weren't as high.
Yep.
And that access to cash, was a great accelerator. I don't know if people are going to be talking about right now in 20 years' time saying, remember how easy it was to get debt in 2024, and is it going to get harder moving forward?
Yeah, I think it's the value, isn't it? The value keeps increasing.
Yeah.
So if you look at back when 2009, value of the same property was 300,000. Same property now, arguably 900, if not more. So you need more deposits. If 10% was the going rate in terms of deposits. So back then you needed 30% plus your stamp duties. So let's say 50K you're in. Now you need 90K plus your stamp duties and all that. And so it's more like 120, 130 and then you're in.
That's a lot of money.
So it's doubled, if not more.
And it's quite hard for people to save that sort of money these days. Like that's a lot of money to raise. A lot of money to raise.
Yeah, which raises the question, right? We're talking about the same properties right now. And we're talking about, okay, it's going to take us 120K to get in the same property that we were able to buy for 50,000 of our money, whether it's from equity or whether it's from savings. We go forward 10 years, we'll be saying exactly the same thing, saying, oh, look, we could buy them for 120 before. Now we need to come up with 200, 250 even.
But it was equally hard as well back then too. Like, sometimes, the incomes were low.
Yeah.
And
it's all relative.
It's
put
all
things
relative,
into perspective. But I think this is the argument around housing affordability is that the speed of growth of property isn't keeping up the speed of growth of wages. But from what I understand, we've had the biggest spike in wage growth in years recently.
Yep.
So wages have risen quite a lot. That it's just this intersection between what you earn and what you can afford and where you should be buying is the challenge. But it's a podcast around property investment. But I still if you are a younger investor, you might be investing with a boyfriend or girlfriend or whatever your version of a relationship is, and you haven't invested beforehand, and you don't have a principal place of residence to draw equity from. It's hard to raise 120 grand.
Of course.
I don't know. This is it. I don't know how people are going to do that these days.
Yeah.
People don't have that much surplus income.
No, they don't. Yeah. Especially with the way inflation's going at the moment. And then also our instant gratification society, Uber Eats, your flashy cars in the sense of new cars, right? Not the high-end cars. And then the mandatory credit card that you need to have.
You know what? I don't see old cars on the road anymore. I'm not talking about classic vehicles. I'm talking about like good old-fashioned student S-boxes.
That's right. Where's the beat-up Corollas, right?
But where are they? Like they just don't exist.
Yeah.
Like if you see when you go, oh, look at that. There's a car from like 25, 30 years ago. No one drives them anymore.
No.
This is the reason why. But Reshmi, how many people sort of find Right Property Group because they were told they've got to buy a negatively geared property. Does that happen anymore?
That they come in
Yeah,
looking for negatively geared.
they go, oh yeah, I need to talk to you because I need to get a negatively geared property because I pay too much tax.
Yeah, that is a common question.
Yeah.
But it comes through during the conversation. Yeah,
Okay.
it is. But it's a lot more like, can you find me a positively geared property? It's more that way.
Do positively geared properties exist anymore?
Yeah.
No,
So
not
that's
investment grade.
Yeah.
Not investment. This is a really, really important point because, again, back to my earlier remarks around the property investment space, it's very hard to find investment grade positively geared properties off the bat.
Yep.
Yeah.
You might need to wait around 10 years.
Yeah.
Only now on some of the stuff, you bought, say, a block of units up in Launton. Only now, never refinanced, right, from an 80% borrow. Only now is that just on. I've just got the last one over the line, so they're all now positively geared.
There you go.
That's
It's
8,
taken
9
time.
years.
It's taken time.
It
Yeah.
takes a lot of time.
But in the meantime, in the background, the value has gone up.
Oh, yeah.
Right? So there's two components to it, right? The value increase and then the cash flow increase, right? So if I look at coming back to negative gearing and why it becomes an issue, you need to be investing and you need to make sure that the cash flow is within your means. So what I'm talking about here is the negative cash flow is within your means. As you go on and build up your portfolio, let's say decades gone by, and if you've implemented the various strategies for each individual property, then the cash flow becomes for your means, right? So in other words, you're able to use that money now for your own discretionary spending or to pay down the mortgages. In the initial stages, you are using your discretionary money to hold on to those mortgages.
You're using your income that you're generating and the surplus of that to actually hold a property portfolio.
Exactly.
And this is, again, the key point you guys have always been very considerate about it is residential real estate investment in Australia is a game of capital growth.
Yes.
Yep.
Yeah, yes, there is a cash flow component of it, but you're not going to get rich in cash flow off positive geared residential real estate. Why do people don't build large portfolios? Because I think also it's a structural thing. At a point in time, they don't transition or pivot enough to actually start thinking about cash flow in a different way. And by that, I mean commercial property.
Yeah, true. And they're always stuck in accumulation phase as opposed to, a true journey has got 3 phases. That's your planning. You need to be consistently planning in terms of your portfolio acquisition, your restructuring, your increasing your rents, the relevance of your portfolio as well, because there can always be sell downs at some point in time. Yeah. Then you've got the actual accumulation phase, which when you talk to any investor that's gone through the hard yards, you want to go through really hard and quick, right? So if let's say it was a 15-year journey that you want to get to the end income or to a neutral cash flow position, the planning happens throughout that 15 years. Because there are various aspects, then the accumulation really should be done and dusted within the first 3 to 5 years. That gives you that 10 years of the third phase, which is the consolidation.
Yeah.
So you got a longer time to focus on paying off the debt. Yeah, so that's the part people don't think about because they think they've got to buy the properties and they continue buying. But buying isn't all. You have to stop at some stage and start focusing on reducing your debt.
You've probably gone through this, and I sort of consider in my sort of portfolio journey in building, there's been sort of cycles of accumulation where you sort of you do a cycle of accumulation, then consolidation, and then you sort of in parallel with that you have another cycle of accumulation and consolidation, and in parallel with that also. So you sort of have 3 or 4, you probably sort of 5 or 6 distinct.
You can see the spikes. In the portfolio,
where you've got like your original stuff's probably still going, and then you keep that, but then you sort of change what you buy at a different speed, and you get another period of accumulation, and then you do the same. I'm seeing that in my own sort of portfolio journey, which is okay. So it means that irrespective of the market cycle or probably we've spoken about sort of design your decade before, you get a whole bunch of different parallel paths running in probably universally at the same time.
And
so when the conditions are right for you, you go and buy or do whatever you need to do, not waiting on, regardless of what's happening out there. When it works for you, you go hard and do it.
Yeah. So. And that might be Okay, you park one particular approach or one particular inverted commas portfolio, and then you start building a new one in parallel with it.
Yeah.
And if I sort of looked under the hood of your portfolio, would you see that? Would there be the sort of very distinct?
Yeah,
There is, and I'm always selling down some properties and reaccumulating.
You love to sell, don't you?
I love to sell.
Yeah.
I don't make any secret that I don't sell down any properties, but they're very strategic sell downs.
reasons.
Where,
We bought them for the reason to sell.
Yeah.
Yeah. So,
it's at some point in time, once it's done its job, right? We sell because then that actually releases more equity. So discretionary spending, paying down mortgages, funding a construction. I'm always replacing the rental income stream, but I'm not replacing the number of properties.
Okay.
Right? So build a granny flat as an example, or sell down one or two properties and buy a block of units. They all become.
so the numbers are fluctuating.
Yeah.
Yeah. And this again is the financing. This is one of the reasons why people don't build a large portfolio. You get quite tactical with it where you can actually keep the debt but sell the property and move the debt to another asset. So now they go through a whole new. Is that difficult to do? Like to change the asset connected with the debt?
You go.
Can be.
It depends on the lender, right?
Okay.
So most lenders will have, the old loan portability box ticked
Yeah.
to say, yes, we can always port the loan, change the security, but it's in the fine print as to the time frame, how the process works, how much money they retain. So you best ask the broker to find out 100% what the process is with your lender if you're planning to do that. And for the uninitiated, we're talking about a security swap. So you're selling your house or your property, and then you are not discharging the loan. So your loan still is active. You're still paying interest on that loan. There's no security, and you're given a time frame. Sometimes it's simultaneous. Other times it's up to 90 days to find a replacement security at the same purchase price. If you retain, not going to chip in more money, at the same purchase price as your original property.
We've done this in our portfolio with the St. George. Was it St. George?
St. George. Yeah.
This is where it gets really tactical because you're sitting there going, well, I don't want to get a new loan. You might not be able to service a new loan. However, you can swap the asset around it for the purpose of
And in that swap over, you tend to pocket a couple of hundred Gs.
Yeah.
Right? So I love doing that because to get a easy finance solution for a large portfolio is rather time consuming. So this is an easier way of doing it.
Yeah.
And as your portfolio grows larger, and this is probably one of the other reasons why people don't hold as many properties, is the finance definitely gets easier. You end up paying more for your finance as opposed to less because you're not part of the norm.
Yeah, and you pay a premium sometimes, that's okay. But if you're smart enough, you can actually factor it in. But I know a lot of property investors they keep all their debt, they just offset it, rather than discharging loans because you never know. To your point, you never know what's going to happen. So having a loan can be an asset. And sometimes, and I've seen people the other way where they just haven't administered it properly. They might have stuff in offsets at P&I and they pay off the loan and it automatically discharges. They go, I want to keep
Fun
it.
Fun fact. So if let's say you've got a redraw feature in your loan and you've put money in, this is just speaking for a friend, not me. And if you overpay your mortgage with certain lenders with blue logos, they automatically internally discharge your loan, right? But they keep the security, but you don't have a loan anymore.
Really?
Yeah. So you have to actually make a phone call and there's a form to fill to say, yes, you'll be discharging, you won't be discharging it, you'll have $1,000 left on the mortgages and not to take any more repayments.
Yeah.
Because if the direct debit goes through automatically, it discharges the mortgages.
Yeah. I remember when I had a whole bunch of stuff offset in the smart property portfolio and I was like trying to work out exactly how much to leave in there because you just didn't want to discharge the loan.
Yep.
And it turns into an absolute nightmare, to try and, but again, that's really quite tactical. So let's summarize the reason why people don't build large portfolios. Structure, mindset, finance, probably key things. Is there anything else, Victor?
The age at which they start.
Age
Really.
at the start, And the type of property they buy in relation to the age. Right? Because that definitely changes as you become older. The types of properties you need to buy is very different. So you need to de-risk it as much as possible. Then, of course, you may start before you've had kids, then kids happen, then you never jump back onto the bandwagon of investing. So life takes over, and that does happen.
Life's probably one of the major reasons why. You lose focus, not a bad thing, but you just probably have conflicting priorities.
That's right.
Yeah. But you can always get back on.
You can always get back on. However, if you look at where most people do go wrong is when they are then jumping back on the bandwagon.
Yeah.
They're trying to compare what they bought before, at what price and where.
And it's hard, and they don't want to do it as well. We've had quite a few.
Yeah, you say, look at your St. Mary's one, right? We bought that for what? 300?
No, it's 212.
212, yeah, that's right. And we did a big reno on it. Yeah. And so today, that's an 800K property plus, 800 plus. We'd be buying it at a song for 800, right?
Yeah, we sold that probably 2 years ago.
Yeah, well, there you go. So if we were to compare that with back then, and we're buying the same type of property in the same area, still strategically okay, but it's a big mind shift change to say, okay, I am paying 3 times what I paid just a mere 12 years ago.
I sometimes find it still difficult to fathom. You said it's only 12 years ago.
Yeah.
Yes.
It was 212,000.
That's right.
It's thereabouts. I think it's 212. Like it's a 2-bedroom place on a corner in North St. Mary's.
Yeah.
Like did it feel like a lot of money back then? I think it did.
It did. Yeah, it did.
Yeah.
And we paid retail back then.
Yeah.
Yeah.
Because it was like everyone, you were out in the western suburbs of Sydney and a handful of maybe other buyers' agents.
Yep.
Back to my earlier point, there wasn't many buyers' agents
That's
around
right.
then.
Yeah.
It was like that was an asset, like having something that most people didn't know about.
That's true. And we paid the right price for its condition.
Yeah.
And I guess when you look at it today, back then, it was a bit hard to fathom that it'll actually cross the 800K mark.
Yeah. Imagine that property. Then. Yeah.
It's just, and I even say, I look at it and go, it's not worth 800 something. And, it's close to the train, close to, all the, I wish I held on to it. But at the point in time, it was the right thing to sell.
It was the right thing to do at the time.
I leveraged the money in a different way, which was good. But it's always hard you can't compare yourself all the time to other people and how they're doing.
That's
I think
true.
you can look where successful people are doing and how they're doing it, try and emulate bits and bops of it. But it's folly to actually compare and contrast yourself. But what I would say though, as a property investor, be very careful. There's one of the reasons why we started podcasting or started the original Smart Property Investment magazine, Vic, and you know this well, was because we thought there was just so much inaccurate information out there. And we started off doing it in the magazine. One of the reasons why we started the Smart Property Investment portfolio with you guys was to go, let's actually do it real and actually
show that it can be done.
Show that it can be done and warts and all, right?
Yeah.
I look at some of the portfolios I hear people are building these days, particularly some you see it on social media. I just go, I just don't believe it. I still just don't believe it. I think there's still so many furfies and so much information out there of how people are building positively geared properties, investment grade. I just don't believe it. It's impossible.
Look,
And
it's a rising market.
There are some people that have done it really well. Right, and not taking it away from them. But when you start using the number of properties you have as the beacon to say, hey, come to me, it's sort of then starts sending the wrong message from a viewpoint. I know we're talking about how we can get people to multiple property ownership, but you don't want it to be just a flashy number. Still needs to come back to, okay, what does it do for you? And why you're investing in the first place.
So what's new at RPG, Reshmi? Anything exciting to share? Anything going on?
Well, we've just moved into the office now.
Oh, okay.
After 4 years?
4 years. So a post-COVID office.
Yes.
Yeah. Back in business.
Back in business.
Always been in business, but back in. How's the team? They excited, engaged, and
I think today was the first day.
Okay.
So I think everyone's pretty cool about it.
Yeah.
So
Has Victor splurged on the coffee, or is he still serving international roast?
We got a coffee machine.
We should give an invite. We'll be doing a wine and cheese night. So let
me know when that's when I'll come out. And I'm sure you have a lot of clients out there as well. And I should.
We'll be hosting some events too.
I can take the tube now.
Oh, yeah, of course you can. It's right next to where we are.
It is, yeah.
Yeah.
So you're in
Norwest.
So right by, I like Norwest. There's so much stuff going out there.
Yeah.
And the next right on track?
It is going to be most likely on the second Tuesday of November.
Okay.
Yes, after the Melbourne Cup
After
Tuesday.
the first Tuesday of November.
Yeah.
Okay.
So once you bet on the horses, you come and bet on properties.
So that should be the headline for the ABC. Mate, you've missed it. That's a really good soundbite.
Gosh.
It's really funny. I sort of dabble in the share market, and I sort of see it like share traders would hate me saying this, but I think most of it's like, I think I think it might be a good investment.
Yeah.
I don't think the same about property.
Yeah.
Because I know it, I like it, I trust it. Structurally, it's a good thing to invest in, but
It is more forgiving when you give it enough time, and there isn't that staggering decay factor if things go wrong, whereas shares can have that.
yeah.
If provided you've bought investment grade properties in the right areas within your means, you just simply can't go wrong.
Well, this is the curly question. I'm going to ask you a curly question.
It's going to be next podcast.
No.
This podcast.
Have you got one for it?
I haven't thought of one.
No.
Typical children. Not missing an opportunity.
No, what really is investment grade? Because everyone bandies it around.
Yes, of course.
What is it?
Yeah. So if you look at investments, there are three components to it. One is the liquidity components. Lender willing to lend you money at a high LVR. Your rent being consistent and being able to increase in value. So therefore the income flowing in that area, and that flows on to jobs in that area as to how close are your employment hubs, multiple employment hubs. That's not reliant on one type of one sector, so no mining towns. And there still needs to be a reasonable commute to an airport. Now, whether it's a regional airport or whether it is...
To run away with your money.
Yes. So, and then on top of all of that, we need to see the exit out of it. Is that area more owner-occupier focused or more investor-driven? If it is more investor-driven, it's not necessarily the right type of property to buy in your portfolio, because your end user, when you do want to sell your property, is going to be most likely an owner-occupier. That is an investment-grade property.
Okay, and no doubt there's a lot more into that.
There's a lot more to it, but high level, this is your first few tick boxes. If they don't tick those boxes,
so that first one is key. I haven't heard anyone sort of mention it that way before. Is the lender willing to lend you at a high LVR?
Yes. Yeah.
So it means that they back it.
Look,
the minimum deposit, and they will take the risk.
Yeah, the lenders have got a far bigger research house than any of us have got, right? Because they're in the business of lending money. And if they're going to limit the lending to 70% loan to value ratio in that area, they're seeing it as a risk. Right? So the risk they're seeing is that, okay, if you did go bad, there aren't enough buyers to buy it off me at the price that you're paying or the type of property that you're buying. So that's your biggest checkbox. Yeah.
So the valuation should really be the purchase price. If a valuation comes in under a purchase price, is that a sign of the non-investment grade?
That's not the
up and down.
because valuations it's supposed to be objective.
Yeah,
it's very subjective, right? I mean, the valuer could have it really they're not the valuers to their defense. They don't get paid much to do the valuation. So if they have to drive from one end of town to the other end to just do a quick valuation. Yeah. And there's dirty dishes piled up in there, and they're not really dialed into what's really happening in the area. They're just going purely on data. Then, of course, your valuations will be shaky. Yeah. And it could be that they also put a risk rating on it that the property is cosmetically challenged, and maybe that is the reason we bought it, right? So the valuation is lower. So we can't use that as a metric, but we can use the lender's loan-to-value ratio as the metric.
So if they're willing to lend 90%, on something, even more, 95.
Yeah.
You can get 95% mortgage.
You can tend to get a few of those, more so owner-occupiers than investors. Yeah. And a really good tell, we were talking about Victoria and how that state's starting to push, one of the things, stamp duties and off the plans. It'll be very soon before won't be long before the lenders start saying, okay, in this area here, when there's a lot of people that have bought in there off the plans, they may start saying only 80% lending, only 90% lending.
Okay.
Postcode restrictions.
They're the tells. All right, so we're coming up to Chrissy. Still got time. What's 6 weeks to Christmas?
Is it?
Gosh.
No, it's a bit long, I say. Please don't say that.
8
I
weeks.
haven't done my
8
Christmas
weeks
shopping
Christmas.
yet.
8 weeks Christmas. 8 weeks Christmas. God.
Yes, the year's certainly gone past, isn't it?
So can I come to RPG HQ now as a client and come and sit in your boardroom and do meetings and all that good stuff, or does that happen?
Is that your curly question?
Yeah, it is.
Curly question.
Early days yet, Phil. Early days yet. Yeah.
Wow.
That's good. So plenty of time though to chat with you guys
Yes.
before Chrissy. Yep.
Yeah, we generally we don't shut down over Christmas. There's still deals happening. We do go down to a skeleton staff.
Some of the best deals are over.
Yeah,
Chrissy,
absolutely.
you know, crackers.
Yeah.
You know.
Yeah.
Yeah. That's
So
good.
there's always, the question is this the good time to get started this close to Christmas? The best time to get started is when you're ready.
Yeah.
Don't let, events in the calendar and events in the news dictate when you start.
Okay. And you guys have mortgage capabilities as well.
Yes, we
that
do.
support.
Yep.
Okay. Nice one. Website. Best way.
It's rightpropertygroup.com.au.
All right, there you go. Jen, check it out. It's good. Well, thank you. I know it's been the Victor show today.
Yes.
Because
it
he's
has
been
because he was ABC.
Mr.
He was
ABC.
learning his
Yeah.
ABCs.
Yeah. Well,
Of journalism.
Maybe. It wasn't too bad. It was, I thought you come across pretty well, Vic.
I think they just got a little bit confused as to how to take the story, like which direction to go.
Yeah,
And they
it's
just
just-
muddled it all up. And
Sometimes journalism is a bit hard, right? If you don't understand something, and property investment, we think it's simple and easy, and you bandy around terms so quickly, and you just assume everyone knows about it. It can probably still be a bit complicated.
Yeah,
But, anyway, thanks for tuning in, everyone. I always enjoy catching up with Reshmi and Victor Kumar at Right Property Group. Remember to go and check these guys out. You can find them on Facebook as well. Right Property Group. That's RIGHT. That's probably where you need to know when the next Right on Track is. You can register and do all that sort of stuff there. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.